The problem with the debt crisis is there's no debt crisis. Because if we did have a debt crisis, that would actually constrain government spending. The problem is we don't have a debt crisis, and there's going to be banks out there that are willing to buy this debt because of that spread, that dynamic. It's one of the dynamics that we just talked about. So this gives the government basically an unlimited credit card to sit out there and spend and spend and spend. And the problem with that government spending is that's what distorts the economy. You know, a lot of people will sit here and say, well, my goodness gracious, if we could just get the government spending back down to 50% of GDP, well, that solves all of our problems, because then the foreigners are, you know, with all this additional supply, there's going to be balance sheet capacity, there's going to be demand. No. That makes the problem worse. It's the example of the heroin addict. Let's say he's got a credit card, he runs it up to 100,000, injecting more and more heroin into his bloodstream that destroys his body and destroys his mind. And you say, well, the problem, obviously, is that he maxed out his credit card. So let's just go ahead and give him another credit card. Are you helping him or are you hurting him? Yeah. No, you're hurting him, because now he's going to inject more heroin, and that's the problem. The debt isn't the problem. It's the fact that he's injecting heroin and more of it into his bloodstream and destroying himself, killing himself, right? And that's the way you have to look at the U.S. economy. And then if you go back to 2001, you see that to a lesser degree, we saw the same cycle, that once the Fed cuts rates, the 10-year Treasury yield actually goes up. It doesn't usually go down for quite some time. You know, when you look at the yield curve, the crash or the recession, or whatever you want to call it, the hard landing, it rarely occurs when the curve is actually inverted. It usually occurs after the Fed starts dropping rates, and that's what makes the curve steepen out and uninvert, and that's when the stuff usually hits the fan. But what I like to do is just go back and look at these cycles, going back to the 1950s, and say, okay, 95% of the time, let's say it plays out this way. So in this business that we're in, there are no certainties, there are only probabilities. But what we have to see is that it usually plays out this exact same way, and the end game, if you just fast forward a year or two, is very rarely a reacceleration of consumer prices. It's usually disinflation that's then followed by an acceleration of inflation due to the response mechanism from the central planners, right? So then you have to say, okay, what is the pin that's going to prick that bubble to where it'll impact the aggregate demand of those people at the top to where they join the poor and middle class, and then that's usually when you see a recession. It doesn't mean you have an absolute crash like the GFC or during COVID or something like that, but you just see a balance sheet recession that may be very similar to what we saw in 2001. But oh, by the way, the Fed dropped by 50 basis points to start that interest rate cycle as well. So what really matters to interest rates at the long end of the curve isn't necessarily supply. This is where most people get confused. It's really growth and inflation expectations. So let me give you a quick example. Let's say you're a bank in the Cayman Islands, and on the liability side of your balance sheet, so your dollar funding, you're paying 2%, right? 2%. And let's just assume that you can match up the maturity with your deposits with a treasury. So let's say that you have a time deposit of 2 years, right? And that's $10 billion, and you're paying 2% for those dollars. How many treasuries would you buy? The answer is limitless. Yeah. There is no limit to the number of treasuries you could buy. 2 year, you could match up maturity if you can pocket the spread. That's all you care about, because your dollar funding costs are 2%, but yet you can get, let's just say 4% on that treasury. You're pocketing the 2%. You don't care how many 2-year treasuries Janet Yellen issues, because you're going to buy more. And what happens is if the interest rates go up because of supply, you're just going to buy more that will bring them back down to the fundamentals as to what moves rates at the long end, which is those growth and inflation expectations. Because if you think that growth and inflation is going to be higher, then you're going to take that balance sheet capacity and you're going to allocate it to lending into the real economy as opposed to buying the treasuries, and then then the interest rates go up because of that inverse correlation between price and the rates themselves. They're not pricing in disinflation or deflation. Not at all. They're pricing in the opposite. And so I know, that takes a lot of people off guard, because they're saying, George, the prices of the stuff that I buy have gone up 100% over the last 3 years. You're absolutely right. But that doesn't mean that this consumer price inflation reaccelerates like it did in the 1970s. It could be the 1940s, where in 1947, we saw the inflation rate, as measured by the CPI, get to 19%. 19, and then 2 years later it was -2. Or it could be very similar to what we saw during the GFC. I'd like to remind people that even if you go back to the 1970s, when you saw the recessions that we had in 74 and then in 80 and whatnot, if we had a debt problem, that would be reflected in interest rates. If Fed funds is at 4.5%, and we had a debt problem, meaning that we've got all this supply that's coming on, we have all this demand that's deteriorating because all these foreigners are dumping treasuries, and they look at the off-balance sheet liabilities, whatever it is, and they say there's no way I want to hold treasuries anymore. The interest rate on the 10-year would not be under Fed funds. It would be 8%. It would be 9%, right? So since you have an inverted yield curve, that in and of itself tells you that there's massive demand for treasuries. Just look at the price. Don't take my word on it. When you got that big spike of unemployment that we typically see in a recession or hard landing, the result was disinflationary. Now, again, I'm not saying that we had deflation in the 1970s. Absolutely did not. But we saw the rate of increase go down when we were in that recession. And now if we're starting at, if you want to believe the CPI at 2.6 or wherever we're starting, if you believe that the probability is high that we have a recession and the yield curve and the cycle does play out the same, over the near term, your base case needs to be disinflation. The market is predicting the complete opposite. They're talking about Trump tariffs inflationary, and that's if they don't like Trump. They're talking about, the Fed cutting too much, 50 basis points, to your point, 25, probably another 25 here in December, and how that's offsides because we've got a booming economy and all these other factors. And, if you go out there and say disinflation and interest rates are going to be lower in a year, I think that you would definitely be a contrarian. And usually that's where you make money. I was very young going into the 1980s, but it reminds me of kind of that Thatcher era or Ronald Reagan. And the proof that I would give to you is watching like Elon on Joe Rogan. Mm-hmm. Where 3 or 4 years ago, Joe Rogan was talking about how, we should expand government through Bernie Sanders and this and this and this. And now all of a sudden he's getting on there. Elon is really influencing him to look at it from a different standpoint, that we need to shrink the size of government, and that's actually the path forward. And Joe Rogan obviously has a massive, massive audience, huge influence, right? And so when you have all these younger males that are watching Joe Rogan, looking up to him, and he's saying and agreeing with Elon, and then they're rethinking it and saying, well, man, maybe all these things that my teachers taught me about socialism, maybe that's not the best path here. Maybe that's not the best thing that we need to do. Commodities, I think you have to look at it through the lens of a commodity super cycle, mm-hmm. and then you have to look at it in a short-term basis, right? If we look, 10 years later, if we look in the rearview mirror, we'll say that the bottom in commodity, or especially oil prices, was when it got to negative, like $38 a barrel. It was that April of 2020. I doubt oil's going back to negative numbers. So from there, you say, okay, it's the trend is likely up, but that doesn't necessarily mean that it goes up in a straight line. Nothing ever does. You could see some downward pressure in commodity prices over the next maybe 6 months or year if that yield curve plays out, but that's going to be your opportunity to go in there and buy. Gold is really interesting because if you believe that we're likely to have a recession, then you have to ask yourself, would we have a liquidity event? Because if we don't have a liquidity event like we had during the GFC, gold probably is still going to continue to trend higher, right? Again, with that volatility, it never goes up in a straight line. But if you have a liquidity event like we had during the GFC or the beginning of COVID, that's usually when gold sells off because ironically it's doing its job because that's the only thing that has a bid. And these big hedge funds, they have to sell something to generate the cash. And the only thing that they can sell is gold. So they sell it, which makes the price drop. But again, if you look at the GFC, at the end of 2008, like we were talking about, or the beginning of COVID, when you saw that big price drop in gold, that was your opportunity. What I do as an investor is I try to start with the question, is it cheap or is it expensive? As opposed to starting with the question, will the price go up or down? Because it takes us back to what we were saying. I don't know if we were saying this on camera or off camera, but the three main things that every great investor has, whether it's Druckenmiller, Buffett, is they, number one, control risk management. So if I'm sitting there looking at the stock market as an example at a 22 forward PE or whatever it is, I'm saying, okay, my risk management, I don't know how much of my portfolio I want to allocate. Maybe some, but I've got to be very cautious there. And then I've got to understand the macro components and what the yield curve is telling us and all these other things, understanding that there is some substantial downside. I need to protect my downside, even if you've got a portion that's long. So then you look at it and say, okay, I got to have an edge. So whether you're investing in gold, whether you're investing in silver, interest rates, you're playing that to dollar or whatever it is, you've got to have an edge. You say, what do I know that the market doesn't know? And then you've got to realize that over the short run, it doesn't matter what you think. It only matters what the market thinks. We could see a downturn in the economy, which would be negative for commodities overall. But again, like we were just saying, I think that's your time to step in and buy, because you've got that asymmetry where the upside is a lot bigger than the downside. So what commodities do over the next 6 months, I don't think is really indicative of what they'll likely do over the next 10 years. So when you look at early 2000s as an example, that was the last big commodity super cycle that we had right then. And I think that we probably were at that mark in 2020. So my point is, I don't think we have a debt problem. The problem is the spending. This is the problem. What they're focusing on, which is reducing the regulation, reducing the bureaucracy, reducing the red tape, cutting the government employees just 50% straight across the board, I think would be a great start. And then what you're doing is you're freeing up all the resources that we have in the United States and that entrepreneurial spirit, the animal spirits that Keynes talks about. You're just releasing that. And then I think you're off to the races. And I think that growth will compensate for a lot of the current problems that we have. Because this is what I'm talking about. You reduce regulations, you reduce the size of government, then you free up the marketplace to go ahead and create more goods and services. And at the end of the day, that's the real wealth in society. It's not dollars, it's not gold, it's not silver, it's goods and services, right? So if a society can produce more goods and services more efficiently, this will increase the wealth. This will increase the standard of living. And that's a separate question from what's going on with the debt. So going back to why I'm bullish, when we get this talk from all these influential people of reducing the size of government, that's what really gets me excited, because I know that's the real problem. I think a lot of Americans said, well, I think the growth of government is completely out of hand, but they're afraid to say it. Or they're afraid to say we need to cut back welfare because, well, if you're an oppressed individual or if you're a victim or whatever, well, then we need to put you up on a pedestal. Where instead of when I was growing up, it was quite the opposite. It was the people that were successful, that were hardworking, that were out there taking risks, the entrepreneurs. Those are the people that society at large actually looked up to. So then you got this guy, Donald Trump, you hate him, love him, whatever. Bottom line is he has been an entrepreneur. He goes out there and he takes a bullet, for heaven's sakes. And most of the people watching that, although they probably never admit it, realize that probably wasn't just a result of that crazy kid that was sitting on top of the tin shed. There were probably some, let's just say, other people involved that were pulling the strings. So you see this guy that's an entrepreneur and kind of representative of that spirit that I'm talking about. You see this guy take a bullet, and then he stands up and says, "Fight, fight, fight." I mean, come on, that has a massive impact, I think, on the psyche. So again, I don't want to put the emphasis on Trump. I think it's more so what he represents in the eyes of the majority of Americans. And then you have to make those asymmetric bets. So going back to the stock market, using that as an example, do I think there's more upside or downside in the market right now? I'd say probably more downside. It doesn't mean that the stock market goes down. It's just looking at it from a standpoint of asymmetry. So I would rather look at things like gold, which I think the asymmetry there is more of what I want. Instead of more downside than upside, you've got more upside than downside. But I think if you start with those fundamentals and then look at your portfolio and set up your portfolio through that lens, that you're going to be way better off. There's no way, you cannot argue that poor and middle class is doing well right now, right? So then it becomes, well, why is the upper class, why are they doing well? Well, it's because of asset prices. Okay, so what you're telling me is the entire U.S. economy is built on asset bubbles. Yeah. And yes, those bubbles may be able to continue into the future, but they can't continue indefinitely into the future, right? We're on this trend where the central planners step in sooner and sooner and sooner and sooner and sooner, and therefore that limits the downside that you have due to that liquidity risk.